This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Now, back earlier in this chapter, as you recall, here in section 3, we came across savings income, and we spent a lot of time already talking about how that savings income is going to be taxed in all its various forms. And the forms that we saw in terms of interest income were interest from banks, interest from building societies, but then also from government securities and corporate bonds. Now, those, of course, would be fixed interest rate securities issued either by the government, for us, the UK government here, or indeed by corporations, by companies. Fixed interest rate for a fixed period of time, and they would be issued by government. And often government securities are referred to as gilt edge because they're incredibly safe. Invest in the government, you should get your money back. Invest in a company, well, hopefully you'll get your money back, along with the interest that you earn thereon. But as you know, companies, of course, might fall upon very hard times and might therefore go bust. And so you could end up with little or nothing. The point about these, they're going to be fixed interest, and that interest will be payable at a certain point in time. So, for example, if a taxpayer owned £100,000 nominal value, this is nominal value, £100,000 of government securities, and they are 3% interest. £100,000 of government securities that pay out 3% interest per annum. And that interest is paid half yearly on the 30th of June in each tax year and the 31st of December. And what we are looking out for, of course, is what is to be assessed within the 21-22 tax year. So here's a little timeline. 6th of April 21 to the 5th of April 22. And there we have, well, roughly there and there, shall we call it. There we have the 30th of June, and there the 31st of December. And what would be received at those dates? Well, it's 3% interest on £100,000, £3,000 for the year. So that would be £1,500 there and £1,500 there. And that's all that we'd need to know. If, for example, these particular securities had been purchased, let's say, before 2021, purchased in 2020. So in which case, therefore, we had owned those securities throughout 2021 and then onwards into the 5th of April 22, into 2022 there. So what would have happened in our income tax computation? We'd have worked on the normal received basis of assessment. So we'd have £1,500 received at 30th of June, £1,500 received at 31st of December, and £3,000 worth of interest income, i.e. savings income, would be included within the income tax computation of the taxpayer. But what we might discover is that either those securities were bought partway through the period, or, as we'll see now, sold part-way through, when I say the period, the tax year. So what about here if these particular securities were sold on, let's say, the 30th of November 2021? They were sold 1 month before that £1,500 worth of interest income would have been received. But it won't be received by that vendor, that taxpayer. What they've actually received within the 21-22 tax year is the only amount credited to them, the original £1,500. So without a certain rule that we're about to see, and I'll take you to the notes further on in this chapter in a moment's time, without what they call the accrued income scheme, only that £1,500 would be assessed on the original owner of that government security, and then on the 31st of December, that £1,500 would be all assessed on the individual buying it. But there's an issue here, not just about interest, but when you buy something and sell something, an asset, then for capital gains tax purposes, the question arises as to whether or not the asset in question is a chargeable asset, in which case there would be a capital gain to compute, or if it was not a chargeable asset, it was an exempt asset, there would be no capital gain to compute. And as we'll discover in Chapter 12 of our notes, in our list of exempt assets, government securities and what we'll refer to as qualifying corporate bonds, they will be exempt. So what that means is when the buyer buys this security, it was sold to the buyer on the 30th of November, they know that 1 month later they're going to receive that £1,500. So if you know that, you'd be willing to pay more for that security now, and the individual selling it would want to be selling it for more than it might currently be worth. The reason being that within that value that we've created for it, we would have the accrued amount of interest in that security increasing the value. So as a security gets ever closer to the date, usually 6 monthly dates as you see here, to the date at which the interest will be actually received, then the value of that security will go up. A buyer's going to have to pay more for that security than they would otherwise have done because they're about to receive, well here, £1,500 worth of interest at the 31st of December. So as you get ever closer to that date when the interest would be received, then the value for the vendor goes up, the price that the buyer is going to have to pay will also go up. So that therefore gives us an issue. When the vendor sells it, a part of the proceeds that they're getting effectively is equal to the accrued interest, but is added to the sales proceeds of this government security, this asset. And this asset is an exempt asset for capital gains. So what that means is you've turned through this sale what would have been taxable income, the accrued interest, into a non-taxable gain. So that therefore would be of advantage to the vendor. Now there's an issue of course for the buyer, but what happens here is we have something called the accrued interest scheme, which in quite simple terms means if you sell that security part way through the tax year, then you look to begin with yes at what was received from the start of the tax year through to the date of the sale of that security, and for us, as we know, it's this £1,500 here. But we add to that the amount of accrued interest. So there you would have 5 months worth of interest to the 30th of November, 30th of June the last payment date, next 6 monthly due date is 31st of December, so it's 5 months to the 30th of November there. So on that basis, you would take, we know that we're going to have £1,500, so that 1,500 therefore, 5/12 of that, 5/6, I beg your pardon, of that 1,500 would now be included within the interest income. It is called the accrued income scheme. So on sale, what now would happen in terms of the tax year 21-22, the tax year of sale, in terms of the interest income to be assessed on the taxpayer who has sold that security. It will be, got lots of circles there, haven't we? It will be the amount received, 1,500, plus the accrued interest to the date of sale. Well, 5/6 of 1,500 I think is going to be £1,250 there. So you'd have 1,500 plus 1,250, you'd have 2,750 being assessed. We wouldn't just assess that individual on the actual amount received. We add in the accrued interest. But I hear you say, if we're going to add in that accrued interest, £1,250, to the taxpayer who owned it at this point in time, up until that date of sale, what happens when the government actually pay the interest of £1,500 at the 31st of December? Is all of that £1,500 then going to be assessed on the buyer? Well, that would be a little bit harsh, wouldn't it? Because the buyer has had to pay more to acquire that particular security. So all that happens, it's very simple, that when you look at the buyer, who for the 21-22 tax year has had it from the 30th of November to the 5th of April, they have received £1,500. That was the amount received. But we then deduct the amount of accrued interest that we have assessed on the vendor, £1,250, and that means, therefore, that only £250 is going to be assessed on the buyer. So what we've done is to correctly assess each of the vendor and the buyer in the tax year in which that security has been sold. The HMRC, the government there, are still going to be paying out £1,500 on the one side, and HMRC will be receiving, in terms of tax on £1,500 worth of interest that has been paid out to taxpayers. But that's going to be a split figure between the vendor of that security and the buyer of the security. And whether it's a government security or a qualifying corporate bond, the same rule will apply here. Now, I referred to this as the accrued income scheme, and if we go through to our notes to roughly where we left it last time, indeed, here in section 3.3, we have this accrued income scheme note. What have we got? As I referenced in chapter 12, we'll learn that gilt-edged securities and qualifying corporate bonds, corporate loan stock, are exempt from CGT when it's sold. So, without the accrued income scheme, a taxpayer would be able to avoid income tax on interest income if the security was sold just prior to the interest becoming payable. Obviously, the closer and closer you get to that interest pay date, then the higher the value, the bigger the amount of accrued income. How would they therefore benefit securities prior to the interest becoming payable? By effectively converting what would have been taxable income, it would have been taxable income if received by that taxpayer on that due date, into what is an exempt gain. And what we've got for you here is an example, which again shows the answer to it thereafter. This time what we've got is that the taxpayer purchases this security on the 1st of July 21. Now, we will of course be dealing with our 21-22 tax year, so it's bought on the 1st of July, part way through. And what we buy is £120,000 nominal value of 2.5% exchequer stock. Again, that is a government security. Now, that actual cost of £125, it's not relevant for tax purposes here, but it would have reflected there any accrued interest that existed. Now, it wouldn't have existed because interest was payable on the nominal value. We always pay interest on the nominal value of a security, not on its market value. You may ask, why would the market value be other than the nominal value? Well, here, because of this issue of accrued income, but also the fact that this is a marketable security. It's paying interest, what do we have here, at 2.5% per annum. Now, if in the marketplace, in terms of interest-bearing securities, that the best variable rate you could get at this point in time from a bank or from a building society was only 1.5%, then clearly if I've got £100,000, then I would rather invest in something that's going to pay me 2.5% a year than 1.5% per year. So in which case, its nominal value will have a higher market value because spend your money on this security and you'll get a bigger return. You're going to get a higher return. You're going to get 2.5% on that value rather than just 1.5% if you went to a different type of investment, like to the bank or to the building society. The reasons behind it don't matter. What you've got to do is to be able to deal with that. So what it meant here, that when we bought it at the 1st of July, the interest had just been paid at the 30th of June. So there's no accrued income within the price that we have paid there. We're going to own it for the next 6 months, we presume, through to the 31st of December, the 31st of December 2021, when the interest would be paid in full. You'd have owned it for 6 months, you receive 6 months interest. There wouldn't be a problem. But what happens here, of course, to make life more interesting, is that on the 1st of December 2021, the taxpayer sold the stock. Now again, what you sell it for compared to what you paid for it doesn't matter, because it's exempt in terms of capital gains. Any increase in value is not going to be subject to CGT. But of course, that would include the accrued interest. So what we've got to do now is to see how we would deal with, as we looked at with our little example a moment ago, how do we deal with the vendor? How would we deal with the buyer? So as we've said, the disposal is exempt from CGT. But under the accrued income scheme, the following amount will be treated as income and included in the 21-22 income tax computation of the taxpayer. Because he sold it there at, when was that, on the 1st of December, because it was sold on the 1st of December, that means there was 5 months worth of accrued interest. There was nothing actually received. But the value of that security has gone up because in another month's time, 6 months worth of interest will be paid out. So what the owner would have been able to do is to convert what would have been taxable income into an exempt gain, because they wouldn't have actually received any interest income in the tax year. Nothing would be chargeable to income tax. The extra 5 months worth of interest increased the value of that security, and those sales proceeds gave rise to an exempt capital gain. There was no tax charge. Hence, we have this accrued income scheme. There wasn't anything received by this taxpayer at the 30th of June. They only acquired on the 1st of July 21. So the only thing to record within the income tax computation of the taxpayer who purchased it back on the 1st of July would be nominal value 120 at 2.5%, the interest rate on that security for 5 months. And that would be some, what's that, £1,250, it would appear there, £1,250. The purchaser will receive the £1,500, 120,000 there, at 2.5% for 6 months of the interest on the 31st of December 21. So they'll receive 1,500. But of course, the accrued income within that, for which they've paid more money to buy the security, that which has already been assessed on the taxpayer who sold them the security, that is deducted there. So they'll simply be assessed on the remaining £250. Hence the accrued income scheme. It's only going to be an issue in terms of government securities or qualifying corporate bonds if you see that during the tax year, for us 21-22, of assessment, that we bought and or sold, as here, that particular security. In which case, for the vendor, how much accrued interest at the point of sale, add that to any other actual amount received. For the buyer, there, deduct that amount of accrued income from the interest that they actually receive after the date of purchase. Now, back in our first lecture together in this chapter, we got introduced to the personal allowance. And we said at that point on the pro forma income tax computation that this deduction, as it is from net income to give you taxable income, was usually available in full to taxpayers. Well, what we're going to see now in this section 4 here is that there is a situation where either that personal allowance will not be available at all or will be reduced. So let's see what we do know and then quickly go on to have a little look at the new bit, this potential deduction in the personal allowance, potentially bringing it down to 0. So what are we told? What do we already know? The personal allowance is, of course, a level of tax-free income. A level of tax-free income, which, as we said, is available to UK taxpayers, usually in full to old UK taxpayers. But if, as we discover, the level of something called adjusted net income of the taxpayer goes above a certain level, then that's it. You start to lose that personal allowance on a proportionate basis until such time as it comes down to 0. So where is that? Well, first of all, what do we do with it? As we've just said, it's deducted from our net income figure to derive taxable income on the income tax computation. And that completed the first part of the income tax computation, which was, you recall, to establish taxable income. It was then that we moved to the second part to calculate the tax liability and, or if necessary, tax payable in relation to that taxable income. It's deducted, as we showed on page 6, and as you've now got used to with the examples you've done up until now, it's deducted in terms of our analysis columns in that set order. Whether it's a deduction of those qualifying loan interest payments or certain loss reliefs from total income to give you net income, or whether it's the personal allowance now being deducted from net income to give you the taxable income. Whichever, those deductions are always made in the same order. They go firstly against non-savings income. If they exceeded non-savings income, it would then be followed, if necessary, by a reduction in savings income, and only then, finally, moving to dividend income, should there be insufficient non-savings and savings income to cover the level of those deductions, here specifically the personal allowance. On your rates and allowances pages, and again, as you've used it in all of the examples up until now, we have a personal allowance of some £12,570, this level of tax-free income, in relation to our particular tax year, which for our exams from June 22 through to March 23 is based on the 21-22 tax year and the legislation based upon that within the Finance Act 2021. However, if an individual's adjusted net income, don't worry about what that is for the moment, it'll be just yet another learning exercise for you. But if an individual's adjusted net income exceeds £100,000, then the personal allowance is reduced by, and it's a simple deduction. It is half, or if you like percentages rather than fractions, 50% of the excess of that adjusted net income over £100,000. So if the adjusted net income was £120,000, that is a £20,000 excess over the £100,000 limit, times a half, and obviously half of 20 is going to be £10,000. What is that £10,000? It's a reduction in the personal allowance. So that £10,000 would be deducted from your £12,570. Our normal personal allowance, £12,570, less £10,000, well, that would equal £2,570. So it's a simple enough calculation. Should whatever adjusted net income might be exceed the £100,000 income limit, then we reduce that personal allowance by £1 for every £2 in excess of that income limit. Now, of course, here we had adjusted net income of 120, but there will come a point at which the deduction itself is equal to or more than the level of £12,570 of personal allowance. And all that will then do is to simply reduce the personal allowance to 0. Don't worry, HMRC don't get vindictive and start giving a negative in terms of your personal allowance. That's not going to happen. It will reduce it down to 0. And that means that once our adjusted net income figure is therefore equal to or greater than £125,140, then your personal allowance will be reduced to nil. So 125,140 minus 100 is 25,140. Take half at 25,140, and surprise, surprise, it's £12,570 there. Now, this information is contained within your tax rates and allowances pages provided in the exam. And all being well, yeah, that's the one there. The information, as we already know, bear with me, the personal allowance for our 21-22 tax year, £12,570 there. There is your income limit of 100,000, above which we start this proportionate reduction of the personal allowance. And there is the limit that you get to in terms of, and mention of that phrase, adjusted net income. If you've got 125, 140 or more, then the personal allowance will be reduced to 0. Going back to our notes, therefore, we already know again what net income is. It's the total income, less, should there be any, the qualifying interest payments and those certain trading loss reliefs. But we see those in Chapter 7. And what has still been a big question mark over this exercise is, so what do we mean by adjusted net income? And adjusted net income is, as you know it, the net income straight off the income tax computation, less two figures, neither of which have you as yet met, but we will do later on in this chapter in section 6 of this chapter. And these are the gross amount of personal pension contributions paid by the taxpayer in the tax year. Now again, you don't have to worry about this now at this point. Very soon you will, when we get to section 6. That's where we'll bring it in. But at this point, if we saw that we had gross personal pension contributions of £5,000, you deduct it from whatever net income you had. Now, personal pension contributions is one type of pension scheme, the personal pension scheme, which during your lifetime, usually of work, you would pay into, in their purpose, of course, building up a fund, a personal pension fund there, from which eventually you'd be able to take your pension when you retire. But there's a lot of details about pension schemes, both the main one and probably the most awkward one to deal with, which are these personal pension contributions, and also those employees who are fortunate enough to have an employer that operates what we call an occupational pension scheme, one run by or on behalf of the employer just for their employees there. And we'll differentiate between those two types of pension scheme. Indeed, we've got Chapter 10 that deals in detail with contributions into and the effects of those contributions into these two types of pension scheme, both personal and occupational pension scheme. So at the moment, this is just a label. If you were told that you had gross personal pension contributions of £5,000, you deduct that from your net income to give adjusted net income. There is then one further deduction, again, that we'll read about and learn in section 6 of this chapter, referred to as gross gift aid payments. Now, the gift aid scheme, those of you who live and work within the UK will probably be familiar with this, but it's a tax-efficient way by which gifts may be made to charity. Rather than just throwing some coins into a collecting bucket for your favourite charity while out shopping one Sunday or Saturday, rather than doing that, whereby you take the money out of your pocket, that's money that you pay tax on in terms of your income, and you put it in the bucket there, again, giving to charity. But there's a more tax-efficient way, and that is to go through the so-called gift aid scheme. Now, again, now is not the time for that discussion. That's in section 6. But if you were told, again, that you had gross personal pension contributions of 5,000 and gross gift aid payments of 1,000. 5 plus 1 is 6, £6,000. Take it off your net income and that will give you your adjusted net income. Take 100,000 from that adjusted net income, only an exercise to perform if the adjusted net income exceeds 100,000, of course. And as long as that adjusted net income doesn't exceed £125,140, then of course you will have a restricted personal allowance. Should it be more than 125,140, you'll have no personal allowance. It will be zero. And of course, as is our way, we now have some examples to practice and to illustrate this newfound knowledge with. We've got to calculate Mike's income tax payable. Now remember, if of course it's income tax payable, we will be dealing with employment income and there will be a figure of PAYE provided to you, the tax deducted at source by the employer on the pay that they have made paid over to their employee. And that figure will be deducted from the tax liability to give you the tax payable figure. So it will come as no surprise here that we have our gross employment income. I don't have to use the term gross there because employment income will always be quoted as a gross figure. That is £108,000 in our tax year, and upon which £32,000 was deducted at source under PAYE within the 21-22 tax year. Now this should be straightforward enough for you to be able to have a go at this particular exercise. We've only got one source of income, it's employment income. What is employment income? It's non-savings income. We have only non-savings income, it's 108,000. Now this of course was a little 2-mark objective testing question in section A, which I think there'll be probably a couple of other things in here for it to be worth 2 marks. But we didn't worry about our presentation. We know here that there's no need to put both a non-savings and a total column, although you'll see the model answer with it for the sake of completeness. But you're working against time in the exam, so you've got 108 non-savings. Right, 108 non-savings income. There's no other income, so it's total income. There's no loss reliefs or qualifying interest payments to look at, so it's net income. So away from that income, there will be the deduction of the personal allowance. Up until now, it's been the standard 12,570. But now we discover this. That figure of our total income, our net income indeed as well, here is 108,000. It exceeds 100,000. There are none of the deductions that would otherwise be made to work from net income to adjusted net income. There's no personal pension contributions, there's no gift aid payments made during the tax year. So net income equals adjusted net income. So what is it? It's, as you see, 108,000. That exceeds 100,000. It's fairly obvious by how much, and you will use that in your calculation of the reduced personal allowance. Take it away, get taxable income. It's all non-savings income. You know what the tax rates are. Apply those rates to your taxable income, work out the tax liability, then take away the 32,000 to give you tax payable. So, over to you guys. Pause now and have a little go at that, please. Okay, well again, as I hope it always is, when we look at our answers, mere confirmation of the answer that you have got for yourself there. So we know that we just got non-savings income. Non-savings income, that is £108,000, of course, there. And then we deduct our personal allowance. Well, we start with 12,570, but because that adjusted net income, as it would also be, at 108 exceeds 100 by £8,000, take 50%, half of that, that's a £4,000 deduction. Reducing that down to 8,570, which of course is how you then deduct it to give you taxable income. Taxable income that is entirely non-savings and clearly puts you above the basic rate limit of 37.7. So the 37.7 is at 20%, and the rest of it up to your total of 99,430, which, do check the numbers on this please, I think was 61,730 I made it. That is at the higher rate of 40%. Get your two tax figures together and that will be your income tax liability. Here, hopefully some £32,232. The question asked for tax payable. That meant deducting PAYE, the given figure of 32,000, leaving just a mere £232 of tax still to pay through what we refer to as the self-assessment system, and would be payable by the 31st of January following the end of the tax year. All stuff that you'll be reading about when eventually you get to chapter 15. Okay, let's just go back to our study note. And as you can see, as night follows day, yet another example follows on from example 8, being, strangely, example 9. This time it's just the income tax liability for our tax year. Let's see what we've got here. First of all, trading income. So that's non-savings, £130,000. Now 130, let alone the other income that is still to be included here, exceeds 125, 140. And it will mean that there won't be any personal allowance. That information alone, of course, would be insufficient to know that there definitely isn't any personal allowance. The reason being that adjusted net income takes your net income and reduces it by those two possible deductions of gross personal pension contributions or gross gift aid payments, which again, to remind you, we will look at in section 6 of this chapter. Well, there aren't any such payments made, so we already know that the personal allowance will be 0. But we've got a lot more income. We've got bank interest, i.e. savings income, of £40,000. We've got dividend income, obviously dividend income, but non-savings, savings and dividend income. Now, we've got the 3 different types of taxable income that we could have. And that too is a big figure of £36,000. So the only issue now that we have determined, we're going to have 3 columns on our computation here for each type of income, let alone the total column. Again, given as a short little 2-mark objective testing question, you don't have to worry about the presentation, but you've got to make sure that you get it technically correct. Don't take shortcuts that lead to an incorrect answer, so be careful. But we've got non-savings, savings and dividend income. We have no personal allowance to deduct. Again, you would be able to say here in your answer that you'll see a formal calculation when you look at the answer, but also a note that says, if you know that the adjusted net income exceeds 125, 140, if you were doing a section C question, you would simply write, as adjusted net income exceeds 125, 140, the personal allowance is reduced to 0. But that would be a section C question. For a section A objective testing question, you don't write anything. All they're interested in, can you get the right result at the end of your calculations? But it does mean, of course, that we've got a lot of income now. And that's an issue about tax rates. What tax rates will now apply? Well, they're very easy for non-savings income, which is tax first. But what then for savings income? Remember those more interesting issues of where any amount is either taxed at the nil rate band or the 0% starting rate band. Oh, well, one of those can be immediately ruled out in terms of the 0% starting rate, for reasons that I hope you will recall. The next question, therefore, is, will there be any savings income nil rate band? I'll leave you to decide upon that. And then, of course, finally, dividend income, where again, there's a dividend income nil rate band. How much is that? Is it available? And therefore, establish your tax liability. So over to you guys again, put that computation together, establish that tax liability, and I'll see you again in a couple of minutes' time when you've done that calculation. So pause now, please. Okay, well, let's do that confirmation exercise. Of course, your answer is the same as this one, hopefully both are the correct answer. So what have we got? Now, again, there's a 2-mark objective testing question. you're not going to bother with the formality of those headings. You will know what you understand to be the significance of those headings. You don't need to tell anybody else. You're only talking to yourself when you answer an OT question, other when you pick that correct letter from those given to you. So we'd be writing down 130, 40 and 36. And again, if you wanted to, you could be at NS, S and D if you really wanted to put that in. Although it would appear that for some reason, right, technical glitches on this one. But you could write in your little working note, savings, dividend. You've got the numbers very clearly with that level of net income, which is also the same as the adjusted net income. It exceeds 125, 140, and therefore there's a zero personal allowance. I've put a little working and a note to this, neither of which would you be doing, of course, unless you were working on a Section C written question, where what you'd say, as is said in the note below, that you will be writing in, rather than this exercise of showing the normal deduction, which obviously brings you down to zero, you'd just be saying that adjusted net income exceeds 125, 140, so the personal allowance is reduced to nil. Job done. But back to the calculations now. Our levels of income were also the same levels in the same categories of taxable income, which we see here. So non-savings, as it always is, first, up to the basic rate band limit at 20. The excess above that, up to 130, is at 40%. On to savings income. Now, of course, with savings income, we've been used to, in all the occasions that we've seen hitherto, of putting in a savings income nil rate band of £1,000 or £500 when we come across taxpayers who are either just basic rate or have gone to the dizzy heights of higher rate. Well, we go to an even greater height here, of course. That is to see that our taxable income at 206,000 more than exceeds the higher rate band limit as given on your rates and allowances pages of £150,000. So we're going to be an additional rate taxpayer. So at that point there, for non-savings, we've taxed 130. It now means that one, as an additional rate taxpayer, there is no savings income nil rate band. There's not 1,000, there's not a 500 figure, there's nothing, because we're additional rate taxpayer, and that's the note that we make there. And very obviously, there isn't any starting rate, as there's no part of savings income that comes into the first £5,000 of taxable income. It doesn't even come into the first £130,000 of taxable income, so it's clearly a non-starter, so to speak. So there's no nil rate band here on savings income, so the first 20,000, why 20? 130 plus 20 takes you up to 150. That is your higher rate band limit, and that is at 40%. Above 150 in total of taxable income, and there's £20,000 of this savings income in that band, that's at 45%. Dividend income, you always get the dividend income nil rate band. It doesn't matter what level of taxpayer you are, it is there as of right. It is 2,000 and therefore at 0%. That's 2 out of the 36, leaving 34,000 to be taxed at. Yes, that rather strange rate, but you're putting it through a calculator anyway. So what's the figure? And get that figure, add it in. And we see there are a rather large amount of income tax liability. Still, if you have taxable income of 206,000, you deserve to have a high tax liability. No question about that. Okay, hopefully therefore no problems with that, and you've already read through, again, the points made within this answer. Quickly back to our study note, and we see there that we've got one last example for you to now have a go at. Again, a very straightforward one. There's just two types of income here, and that will create, given the numbers involved, just a slight differentiation from what we were doing in the previous example. We have trading income, non-savings. We have bank interest, therefore savings. The non-trading, the non-savings trading income, I'll get it right in a moment, 102,000 plus your bank interest of 4,000. That means two things. One, at £106,000, that you've gone above 100,000 in terms of net income, and likewise here adjusted net income. So there's going to be a fairly obvious reduction. 102 plus 4 is 106 minus 100, take 50% of it. An obvious reduction in your personal allowance. You'll take away that personal allowance, firstly from, and given the size of it here, only from your non-savings income, and then you'll proceed to tax. That, of course, will use up all of your basic rate band limit and then move into higher rate. You then come to bank interest, but of course, we're now only a higher rate taxpayer. So what does that mean in terms of savings income? Again, over to you. Calculate the income tax liability for James for our 21-22 tax year, please, and pause again at this point. Well, here we go again, and again, hopefully no problem so far as deriving the correct answer on this one. We do non-savings income, the trading income 102,000, savings income, your bank interest, £4,000. That meant that both net income and, as it always been in the examples so far, it is the same as adjusted net income. And because that exceeds the 100,000 income limit by £6,000, we had this £3,000 deduction here, bringing us down to a revised personal allowance of 9,570. Take it away, as we always do, firstly from our non-savings, and usually as it is only from non-savings, because usually the non-savings income is bigger than the personal allowance. Get your taxable income figures. Firstly, the 92,430 on non-savings. Again, basic rate band limit is exceeded. That's all at 20%, up to the remainder of it to hopefully bring you to that total of 92,430 there. And that will be at 40%. Savings income, this was the only area that if you're going to come unstuck you might have done, and that was remembering that if you've got a higher rate taxpayer, then we do get a savings income nil rate band, but it's only £500. That goes in at 0%, the remaining 3,500, we're in the higher rate band, and therefore you use the normal 40% rate. And in that way add up, hopefully all the numbers come together to give you that figure of income tax liability. Now, as I said there a moment ago, and have continued to say throughout the examples you've done, both net income and adjusted net income have been the same, because in section 6 we will see where those gift aid payments and those personal pension contributions come into play. We'll see what they are and how we deal with them. One impact of which is that those amounts would serve to reduce the net income down to adjusted net income. But there'll also be a further impact as well. But we'll see that when we look at section 6, and you'll have examples that deal with those particular issues. So don't worry, we'll be coming back to it and dealing with that issue. Back for the moment, though, to your study notes. And again, just one other issue to deal with in the context of the personal allowance. And that is that there's a transferable amount of the personal allowance, as we read here in section 4.1. And what we have is an election that is available to taxpayers. Now, you'll see that through your studies of all the various taxes, that there's a number of elections that are available to taxpayers. Now, if an election is available, then presumably you're only going to make that election if it's beneficial. So always when we see elections, always ask yourself that question. How does this benefit the taxpayer? What does it do? How does it, as it must do, serve to reduce the overall amount of tax liability here? How does that work? What are the circumstances in which we see that election being available? So think about it rather than just a learnt response. This is that particular relief. Think about the situation in which it arises and therefore put that in your head so that when you see that situation in an exam question, you'll know that that particular relief is available, that election is available, and what it is that and how it is that it improves the position for the taxpayer, or as we'll see here, taxpayers. Okay, and we'll talk about that again as we go through. But always think about them. What's the situation in which that election would become available to give you some sort of relief? What does it do? How does it benefit the taxpayer? So what have we got here? An election may be made to transfer a fixed amount of the personal allowance to a spouse or civil partner. What we know is that every taxpayer, whether single or married, whether child or adult, whether male or female, it doesn't matter. We are all treated the same. And that is, we all have our own income tax computations, and we all have our own available personal allowance. Though if, of course, your income is at such a level, you might discover that either that personal allowance is reduced or reduced indeed all the way down to zero, as we've just been discussing. Here we're going to be looking at much lower levels of income, and we'll discover the situation in which it would benefit the taxpayers here to make this election. Where there's this connection between taxpayers, spouse or civil partner, it is in those circumstances that those taxpayers, the married couple or the civil partners, they are able to do something that improves their tax position. We'll see what it is. Transfer a fixed amount of the personal allowance. This is not, well, you transfer whatever you like. No. Here there is a fixed amount. Don't worry, again, it's not one that you're going to have to learn, though you probably will remember it, because it is given within your rates and allowances. Now, the amount is set at £1,260 for our 21-22 tax year. And again, that amount, the amount of the transferable personal allowance, will be given in the tax rates and allowances provided in the exam. So if I just reassure you of that, here the information we've been looking at under the heading of personal allowance, and there's this one, the transferable amount at £1,260. So if you have a little blank on that in the exam room, don't worry, it's there on your fact sheet. Look up your rates and allowances. Okay, going back to this, it's a fixed amount of transfer. Now, what we'll discover is, and where most students might, if you're going to make a mistake, make one here, that this relief is not given as an increase in the personal allowance of the transferee. So we always reduce the personal allowance of the transferor, spouse or civil partner, by £1,260. So they've got a lower personal allowance by that sum. But we don't then give that £1,260 as an increase in the personal allowance of the transferee, spouse or civil partner. Instead, what we do is to give that transferee, spouse or civil partner a reduction in their tax liability. A tax credit is provided to them to reduce their tax liability. And that's what's said here. But as a tax credit to be deducted in deriving the tax liability of the transferee taxpayer, spouse or civil partner, and is taken at the basic rate of 20%. So for 21-22, the transferee spouse, there's the transferable amount of the personal allowance from the transferor spouse, taken at 20%, is some £252 as a tax credit, i.e. when you've calculated your basic rate tax, and you'll find here it will only be basic rate tax, when you've calculated your basic rate tax, rather than then that in the absence of higher or additional rate being the tax liability, there'll be a reduction in that tax charge equal to £250. Now then, though it is a tax credit, it can only reduce the tax liability. It cannot create a repayment. So all it would do is, if your tax liability prior to this deduction were, say, to be £200, then the 252 deduction would simply bring that tax liability down to zero. It wouldn't go on to create a repayment of £52. That's not going to happen. So here it will reduce your tax liability to zero but it won't go any further. Now, I said there about you will be dealing with a basic rate taxpayer. The election is only available when both taxpayers are either just basic rate taxpayers or non-taxpayers. Now, having said that, there's one specific situation where this particular election is going to be worthwhile for the tax-paying spouses or civil partners. It's only likely to be made when one spouse is a non-taxpayer, so their income does not exceed the personal allowance, and therefore has an amount of unused personal allowance. That would otherwise be wasted. If one spouse has income of £8,000 but a personal allowance of £12,570, clearly much bigger than their income figure, and on that basis their taxable income would simply be zero, and they'd have wasted a significant amount of personal allowance. Now then, they won't be able to get back the benefit of all of that unused amount of personal allowance, but some of it, this transferable amount of the personal allowance, some £1,260, will be transferable to the transferee spouse. So the transferor tends to be a non-taxpayer, whereas the transferee is a basic rate taxpayer. So, as we've said there, has an amount of unused personal allowance that would otherwise be wasted, and the other spouse is just a basic rate taxpayer. In that situation, you can move £1,260 of personal allowance that would otherwise or may otherwise have been wasted across to the transferee spouse or civil partner, and that benefits to the tune of a 20% tax credit, a reduction by £252 in their tax liability. In that circumstance, it's worthwhile. Well, apologies there that on the original recording of this particular lecture, we had lost the video. The video that is of me down in the bottom right-hand corner of your screen actually telling you the words. The words, however, you could hear. At least you got the audio on. But sadly, it would appear we've discovered that on the editing of this particular lecture, that the audio went for the last part of it. So we got neither the picture of me nor the words from me. Hence, we're now re-recording. You can tell we must be re-recording this at a later point in time, as the hair is significantly longer than it was on the first version. What we had done within this particular section was to discuss the transferable amount, of course, of that personal allowance, which shown the situation in which it would be worthwhile, and that is where we have a non-taxpayer with some amount of unused personal allowance who has a spouse or civil partner who is a basic rate taxpayer. That this fixed amount, not just any amount, not the unused amount, but this fixed amount of personal allowance could indeed be transferred over to the other spouse, the basic rate taxpayer. That would allow them not to have an increased personal allowance, but of course to get this tax credit as a reduction in their tax liability, this £252 reduction in the tax liability. So between the two of them, the spouses, the civil partners, would be £252 better off in that respect. The only bit of this note that had not been covered in that first recording was just this admin bit here, which is simply about if you're going to make an election, then there's got to be a time limit within which it should be made. These admin parts are probably not the bits that you need to be focused on a first look through these study notes and lectures, and it is hopefully some considerable time still before you take the exam. The admin bits, notably chapters 15 and 23, 15 for personal tax and then 23 for corporate tax. Those admin bits, I would recommend that you leave until closer to exam date. Focus to begin with on the doing things, how to prepare these computations, the content of them, how do I discover, like here, the amount of taxable income, and then how do I tax it. Do your computational stuff, practice that, make sure you're okay with it, and then closer to the exam date, given that admin stuff is all learning, and that's maybe short-term memory, you just do it in the short term. The only thing that matters there is you know the stuff that you need to know on the day. You can forget it the next day, therefore. So the election there got to be made within 4 years of the end of the tax year to which it should apply, so plenty of time in which to make it, though if made within the tax year concerned, the election will then remain in force for future years until either it is withdrawn or the conditions are not met. If this situation is likely to repeat itself year on year, that option allows you then to get automatically this election going through without having to separately make that election following the end of each such tax year. Okay, what we need to do now, therefore, is just to practice that. And there we go. We have example 11, where we can see that the requirement is longer to read than the actual question itself. But what are we expected to do? We've got to calculate the income tax liabilities of David and Victoria. Ooh, there's a famous couple from years gone by. Assuming that an election is made to transfer the transferable amount of David's personal allowance to Victoria, and state the date by which the election should be made. Okay, the brief information in the question about our happy couple, David and Victoria. David and Victoria are married, and in the 21-22 tax year, David had a trading income assessment of £10,000. Not very likely, is it? Probably several more noughts on the end of that for the David that I'm thinking about anyway there. But this David has got £10,000 of trading income assessment, and then Victoria has got a salary of £30,500. So immediately we can see that with only £10,000 for David, there's a significant amount of unused personal allowance that exists. And Victoria, with a salary of £30,500, is but a basic rate taxpayer. Therefore, the election is going to be worthwhile to move over not the unused personal allowance that David has, but this transferable amount, this £1,260. But that, of course, at 20% will then be a reduction in Victoria's liability. So what we need to do, therefore, what you need to do to calculate those tax liabilities, very clearly David will have no tax liability. He's going to have his trading income assessment of £10,000. His revised computation, of course, will show a reduced personal allowance because the £1,260 is going to be transferred over to Victoria. But it's still got to be nil taxable income there, so no tax for David. Victoria, she's only got a salary of £30,500. She's got her own personal allowance, of course, to bring you down to taxable income. That's all in basic rate. It's non-savings, basic rate taxable income. Calculate that, but then take your reduction for the transferable amount of that personal allowance. Your £1,260 at 20%. And that, of course, comes to £252. So pause now, therefore, just to work through that for yourself, and then we'll have a quick look at that before finishing off this long lecture. Okay, well, hopefully no problems there with the answer to example 11. David, as we said here, is going to have nil taxable income, given that the trading income was 10. Notice the reduced personal allowance. We've got that transferable amount being transferred, reducing, therefore, David's own personal allowance. But again, with the level of income such that it is, there's still no taxable income. Routine computation to begin with, so far as Victoria is concerned. Her employment income, her personal allowance, her taxable income, it all being non-savings, taxed at the basic rate of 20%. But we've made this transfer, sensibly so, because whether David had a personal allowance of £12,570 or £11,310, we're still going to have no taxable income. We were just wasting all of the unused personal allowance. This way, we get this tax reduction here of £1,260 at 20%, the £252 tax credit, reducing down, therefore, Victoria's tax liability accordingly. There's your situation in which that is most likely. The Election, of course, must be made within 4 years of the end of the tax year, it being 21-22. Well, that's going to make it by the 5th of April 26. Again, that is far less likely. This issue got to be really in a Section A objective testing question if it's going to be tested at all, where the likelihood is, of course, that we're going to have to work out the revised tax liabilities of the couple concerned. And those, as you can see, are nil and £3,334 respectively. Okay, that now brings this recently edited lecture to an end. Personally, I'm hoping that there's no more problems with the future lectures that require this, but I look forward to seeing you next time, probably with short hair again. I'll see you then.